Good morning to everyone who's joined us so far. I'm Peter Stevens. I'm president of the TMA UK chapter, and I'm pleased to welcome you to this latest TMA webinar, which is being held in conjunction with Kroll, a division of Duff & Phelps. Title of it is Cryptocurrency, Not Just Physical Assets Require Recovery and Investigations. So looking forward to this one. A very big thank you to the team at Kroll for putting this panel together. I know they're all incredibly busy and really appreciate them giving up the time for setting this up for us. Joining me on the webinar, we have Andrew Whelan, Associate Managing Director, Marek Marecki, Director, and Hugo Hoyland, Director, and they are all from the Business Intelligence and Investigations practice at Kroll. Please do note the session is being recorded and will be made available to you afterwards. In today's session, the panel will discuss what crypto is, how it works, and share a recent case study. There will be a Q&A session at the end where we'll be answering questions from the audience. So please do submit your questions through the question box, which can be found at the right-hand side of your screen at any time during this webinar. Briefly, for those of you not familiar with the TMA, we are a global not-for-profit organisation with the most professionally diverse membership across the corporate restructuring, renewal and turnaround space. I also want to take this opportunity to thank our corporate partner, John Pye & Sons, as well as our other corporate sponsors that you can see listed here. And we're extremely grateful for their continued support, especially in these difficult times. With nearly 10,000 members in 54 chapters, belonging to the TMA allows members to gain access to knowledge and experience and expertise, which is vital in dealing with the incredibly challenging times businesses are now facing. In addition to providing a wide and deep network for members to benefit from, today's webinar is a great example of the value added we're looking to bring members in these strange times. We've been delighted by the response we've had to the webinars, with over 5,000 individuals registering to attend our events this year. Today is no different, with over 100 registered for this event. We've got a couple more events lined up before the end of the year, and we're well into planning for next year. Details can be found on the TMA website. Of course, we're always looking for new members and supporters, and if you're interested, please do visit our website for more details or speak to Naira McGill, our General Manager. With that, I'll pass over to our first speaker, Andrew, to take us through the first part of the session. Andrew, over to you.
Thank you, Peter, and good morning, everybody. My name is Andrew Whelan, and I'm an Associate Managing Director in Kroll. As Peter said, we're going to spend the next half hour or so talking about cryptocurrency. And before I do so, I'd just like to spend 60 seconds or so talking about Kroll and explaining who we are. Kroll, we are a global investigations and intelligence company. We were formed around 45 years ago. Our objective in pretty much all assignments that we undertake is to find out more information for our clients, and that is in a whole range of scenarios, usually to help mitigate risk and or provide answers to their problems. We're a division of Duff & Phelps, and collectively we have more than 4,000 employees globally, and I believe now we're in 70 office locations around the world. Broadly speaking, there are 4 divisions within Kroll, and of course there is some overlap between these divisions, but they are the Business Intelligence and Investigations practice, and typically business intelligence and investigations are called into scenarios ahead of a strategic decision to find out information, or when something has gone wrong and a client needs answers to their problems. We have a strong and growing by the day cyber risk practice. We have a compliance risk and diligence practice, and we have a physical security risk management practice. Hugo, Marek and myself, we sit in the business intelligence and investigations practice, That is where we do the cryptocurrency work, and that is really what we're going to talk to you about today. I'm going to hand over to my colleague Marek now, who's going to provide a explanation of what is cryptocurrency and how it might be relevant to you.
As I said, there is a quick apology to make on my part, which is my camera doesn't work, but that's the beauty of having children in the house. And if we just kind of move forward, I'll just go briefly into the kind of background of cryptocurrency. Essentially, cryptocurrency is an internet-based medium of exchange which uses cryptographical functions to conduct financial transactions. Key to this is the fact that it is decentralized, which in the very nature of being decentralized should theoretically make it immune to government control and interference. A little kind of glossed over fact is that when Bitcoin was first introduced, being the first real genuine cryptocurrency as we know them today, it was never actually intended to be a currency as such. When it was announced to the world, it was introduced by Satoshi, who's the creator of Bitcoin, as being a peer-to-peer cash system and nothing more than that. Again, his vision focused on decentralization, as in the 90s there'd been numerous previous attempts to create some sort of digital money, but they all seemed to fail, and he'd identified that the key to the failure was the fact that they were all centralized and there was a controlling mind. So he essentially set about creating this currency with no central entity, purely like a peer-to-peer network for like file sharing, but involving cash. I mean, there are several key areas within cryptocurrency, like the wallet, which is the kind of, I suppose it's a digital entity which is used to secure, send, receive currency such as Bitcoin, Ether, Monero. All cryptocurrencies essentially have a wallet. Wallets can take several different forms, from like being actual hardware wallets to being online digital wallets. Within cryptocurrency, you've got numerous different areas. You've got the currencies which are designed to act as a currency, or rather as a peer-to-peer cash transfer system, such as Bitcoin, Litecoin, and Dash. Some have some degrees more privacy, such as Dash, which is the capability of essentially scattering payments to kind of make them slightly less, how to put it, well, it's less easy to identify the person controlling. They're more pseudonymous and autonomous. Then you've got the smart contract systems, which are generally, like most commonly, Ethereum, as well as utility tokens, stable coins, and privacy coins. The privacy coins are the most controversial of that group, as they are created essentially to completely obfuscate the kind of payment and the originator and the recipient of any payment. They use various, what's also interesting is that as time has progressed, even currencies which have been technically open, such as Bitcoin, can be made more obfuscated by things such as the Mimblewimble protocol, which is something that numerous people have been trying to bring in. When you look at the kind of the general ecosystem, I mean, these are slightly out of date figures, but they give you an idea of how popular it's becoming, and also explain to an extent why it's becoming more, I suppose, a larger target for criminals, with cryptocurrency theft growing both in terms of frequency and the breadth of targets. They're not just cryptojacking and targeting exchanges. Currently, you're looking at about $1 billion worth of cryptocurrency being stolen each in the first half of last year, and that number has grown this year. If you look at the kind of ecosystem as a whole, as you can see, it can be split almost into the open and acceptable market versus the kind of less or unregulated market, which may be more, I suppose, open to criminals acting. you know, as you look at this table, effectively you've got the kind of, I suppose, various sectors which are involved in using cryptocurrency. The ones on the left with the blue are the kind of areas, well, they kind of, Hugo, maybe perhaps you could explain this chart slightly.
All we're seeing here are the types of activities that certain companies are involved in. So, for example, the most common, I think we will all know, are cryptocurrency exchanges, who act as a way of introducing different buyers and sellers to each other. So someone might want to buy Bitcoin from someone else, they'll act as a marketplace for that transaction to take place. Conversely, they can also do the conversion from fiat into crypto. So it's typically these kind of exchanges and mentions, crucially, of those exchanges that we're interested in seeing whenever we come across them in any form of investigation, in the solvency scenario as well. Mentions of those exchanges are key. These slides will be shared with you afterwards. We just thought we'd give you a bit more of a sense of the breadth of the types of companies that are involved in cryptocurrency. For example, reputable online retailers. There are plans for, you know, the Amazons of this world to start accepting cryptocurrency as payment. You will have seen a couple of weeks ago PayPal announcing that it was going to start processing cryptocurrency transactions. The very conventional players seemingly getting involved in the world of crypto.
And taking that a bit further forward, in Time magazine, they have a regular columnist who's a futurist named Thomas Frey. He's kind of predicted, and with good reason, that cryptocurrencies may displace roughly 25% of national currencies by 2030. Looking at the businesses which have already adopted cryptocurrency, as Hugo mentioned a few, that PayPal is looking at it, Revolut now accepts cryptocurrency, and far more kind of, I suppose, less obvious businesses are also accepting crypto, in the sense that Virgin Galactic now accepts Bitcoin for space travel tickets. Save the Children, the well-known kind of children's charity in the UK, accepts donations via Bitcoin. Tesla allows purchase of cars via Bitcoin using an app named ShakePay, and you know, the list is growing. The kind of there is a good chance that more businesses will slowly start to accept cryptocurrency. However, what is creating a slight lag in this adoption is that there are a few hurdles that still need to be overcome before there's this mass adoption, and they can really be split into three parts. Firstly, a general lack of knowledge about cryptocurrency. Second, the kind of price volatility in the market. And probably the third area is the fact that there's still quite nascent regulation within the industry. Blockchain, and I suppose you can split it into two concepts. There's the asset itself, such as the Bitcoin, which is essentially a transactional record. There's no such asset as a Bitcoin, and no real world assets such as Bitcoin. It's all purely a transactional, a history of a transaction value being passed from A to B, and basically can be passed to anyone. There are no actual assets held as such. The blockchain itself is distributed across the globe. It's essentially a database. If you think about a database in the kind of traditional sense, that's essentially somewhere where it fits. The key difference between blockchain and a typical database is purely its structure. A blockchain kind of collects information in groups, which are known as blocks, and these blocks have certain storage capacities, which, when filed and chained and put, chains onto the previous block, form a chain of data which follow from A to B to C. So in that sense, there is a slight difference, but essentially they are no more than databases. Again, when it comes to examining an asset on the blockchain, such as Bitcoin, you will not find a Bitcoin on any kind of machine as such. You may find the private keys, the public keys, which have been stored on a computer, and these may authorize you to, if they are in your possession, may authorize you to spend the asset or move it and take control of it. You may also find lists of accounts, wallets, transactions, and other services which have used that Bitcoin has been used on historically. You may also find additional metadata, including details related to the asset which aren't publicly available, such as, the transactional history on an Electrum wallet, for example. On the other hand, the blockchain is open to all. It's immutable and will show a history of the entire cryptocurrency history that you're looking at. So you can see all transactions, and kind of key to any cryptocurrency being effective is the fact in the background you need miners. In principle, anyone can be a miner. Since it's a decentralized network, it has no authority, and no one is delegated the task as such. Most cryptocurrencies work on a proof of work concept, although some also use proof of stake and other kind of principles for allocating the currency. Bitcoins are only created if miners solve cryptographic puzzles, and this is the kind of, I suppose, most commonly used principle in crypto. And since the difficulty of this puzzle increases over time, the amount of computer power needed to solve the puzzle also increases, so people need to upgrade constantly in the technology used. Also within cryptocurrency, you tend to come across exchanges, which are literally businesses that allow customers to trade the cryptocurrencies or digital assets, such as fiat money to exchange to cryptocurrencies. A cryptocurrency exchange essentially is a market, can take one of two roles. Either it can be a market maker that uses the bid-ask spread and takes transaction commission for its service as such, or it becomes a matching platform that simply charges fees for matching an individual seller to an individual purchaser. Going on to some of the other things, like the types of wallets which you can use. Cryptocurrency wallet, as we said before, is a secure digital wallet used to store and receive the currency. You will need to use a cryptocurrency wallet should you wish to trade and store currency yourself. Some wallets are built for single cryptocurrencies. Some can use multiple cryptocurrencies. Some wallets you'll manage yourself, and some, like those found on exchanges, will be custodial, which essentially in effect work like banks. There's a whole range of wallets to kind of choose from. I think if we go into the kind of key properties of cryptocurrency, there are kind of 5 key properties in the sense that it's an irreversible thing. Like after confirmation of any transaction, it cannot be reversed. Once you send the money, you've sent it. No one can help you get your funds back. And if you've sent your funds to a scammer, the only way back is essentially taking some sort of legal action and trying to reclaim it physically from them. The second kind of key property is the fact that it's pseudonymous. Neither transactions nor accounts are technically connected to real-world entities. You receive Bitcoins on kind of the so-called addresses, which are randomly seeming chains of around 30 characters. While it's usually possible to analyze the transaction flow, it isn't necessarily possible to connect real-world identities to those addresses. The third key factor is that it's fast and it's global. The transactions are propagated pretty much instantaneously in the network and are usually confirmed within a couple of minutes. Obviously, the higher the fees you pay, the faster they're confirmed. Since they typically happen in the global network of computers, they're completely indifferent. Like when it comes to physical location, and it doesn't really matter if you send Bitcoin to your neighbor or someone on the other side of the world, it will take the same amount of time. The fourth key factor is that they're secure to an extent. Obviously, anything digital is inherently insecure in the sense that people will come up with ways of targeting the network as such. Cryptocurrency funds are locked in a public key cryptographic system. Only the owner of the public key or someone in possession of the private key can send a cryptocurrency. Strong cryptography and basically the magic of big numbers in the kind of sort of sense make it impossible to break that. Bitcoins are theoretically, more secure than actually Fort Knox and keeping gold within a building. The fifth key property is the fact that it's permissionless, and you don't have to ask anybody to use a cryptocurrency. It's basically a software that is open source and anyone can download for free. Once you've installed it, you send Bitcoins, or other cryptocurrencies, of course, and no one can prevent you as such. There is no central controller, there is no gatekeeper. Looking at it from a different perspective, it has kind of two key monetary properties. Firstly, being that it's always got a controlled supply, in the sense that most cryptocurrencies limit the supply of tokens. In Bitcoin, the supply decreases over time, and there will be a finite number mined around the year 2140. All cryptocurrencies control the supply of a token, and it has schedules written into the code, which essentially means that the monetary supply of a currency in every given moment can be calculated today, and there will be no shocks, there will be no surprises. The second monetary property is that there is no debt but bearer. The fiat money on your bank account is created by debt, and the numbers you see on your ledger represent nothing but debts. It's a system of IOUs effectively, whereas cryptocurrencies don't represent debts, they purely represent themselves. So it's a slightly different way of looking on money, I suppose.
Great, thank you very much, Marek. I appreciate that's all quite a lot of information. So we're going to try and see what all of that means in practice by going through a typical insolvency type scenario, which is what we'll do for the next 15 minutes or so. The very first thing to bear in mind when dealing with cryptocurrency in general, but especially when it comes to an insolvency scenario, is before even getting involved, asking yourself the question, can you safely store any cryptocurrency that you might be taking control of? Can you actually physically take control of it? Can you store it in an insured and safe way? This is where the idea of custody solutions comes into play. There are some companies out there who have decided to create their own custody solutions. So we are aware of some insolvency practitioners who've decided to have their own custody solutions, which are insured in the same way that they would have custody solutions for other types of assets. But generally using a commercially available custody provider as a solution to store safely, securely, in an insured way your cryptocurrency is typically the easiest way to go about it. So the issue with cryptocurrency is, as we talked a little bit about during some of those core concepts, is if we're talking about the example of Bitcoin being the most common cryptocurrency, if we're talking about Bitcoin, the Bitcoin is not physically stored on a device. So we have heard stories of people saying, great, I've got the laptop now, and the laptop has got 10 Bitcoin on it. I now control those 10 Bitcoin because I've got the laptop or the hard drive. That's actually not the case. What you're trying to do is control the private keys that enable access or the release of that Bitcoin from a specific cryptocurrency address. And those private keys were seen on a slide before there, usually stored maybe within an external USB looking device, a hard wallet, usually offline, or stored simply on a piece of paper, a series of words, seed words to help someone remember what that private key would be. Now, we've heard examples of people taking control of those private keys, say a USB stick, and coming back into the office, just putting it in a drawer, leaving it in the drawer, but actually the private keys on that USB might control, I don't know, $50 million worth of value in Bitcoin. So storing them in a drawer is not the most effective way to look after that. So this is why you have to think about custody solutions. We've put a few there on the chart. Asset Reality, for example, with its partnership with Fidelity Digital Assets and Chainalysis, does provide that custody solution, which means that on the day when you're actually going into the business, when you're actually looking at some of these assets, you can immediately transfer them out of the control of the business and into your control. by moving it to an address that effectively you are the only one, along with your custody provider, to control. So you can be sure that they're not going to move, they're not going to go missing. No one else has the private keys to be able to move those assets, and you can actually get to an asset realization a lot quicker. So really, this is day zero before even thinking about doing any form of a case in crypto. Have you got a custody solution? Do you know what you're going to be doing once you've got the crypto? Now, day one, we've just arrived in a situation, in a solvency situation. We've got the Acme Clothing Company, a short-lived, unfortunately, e-commerce business that dealt with the sale of printed t-shirts and face masks. Business was going well. A couple of issues meant that the business has collapsed, unfortunately. The typical assets that we'd be looking at in a normal scenario here might be its inventory, its equipment, customer list, maybe some intellectual property it has as well. We are all acting for Liquidators Limited. We've got a lot of experience and a very good reputation for dealing with insolvencies in e-commerce and manufacturing. And we've been appointed to wind down the operations and obviously maximize the value of the assets to fulfill the debts owed to creditors. Now, question one on the day, the first thing we might want to find out are what payment processes does Acme Clothing Company use for e-commerce and in-person sales? This is the answer we get back. We hear they use PayPal, Square, but also BitPay and Coinbase Commerce. So not conventional payment processes that we may be used to seeing in other cases, but might be something to do with cryptocurrency. Now, it's important at this stage to really stress that cryptocurrency is not a bad word. It's just a technology, it's just a means of payment. A lot of people are using it more and more. So what should we do? Well, the normal line of questioning has already started by asking things such as, who are your payment processors? We want to keep asking those types of normal questions. Now, for Acme Clothing Company in this scenario, accepting cryptocurrencies is perfectly normal. It's a way that they're able to sell their products, and their transactions are handled very much like other normal fiat transactions. So we would be looking at what kind of ledgers they keep internally. Who do they partner with? Who are their e-commerce platforms? Who are their payment processors? What kind of records do they keep that we might be able to get access to? How does the remittance of funds actually happen? And this is where we can go through a few examples of how typically a company like Acme Clothing Company should receive its crypto. So in the first scenario, very simply, customer goes to an e-commerce platform, pays for the product in Bitcoin, and the Bitcoin is transferred to the custody provider. So in the same way that we, in this scenario, as the insolvency practitioner, will have our own custody provider to be able to store the crypto that we end up recovering and try to realize the value of, then Acme maybe also has their own custody provider. And they are essentially outsourcing the custody of the cryptocurrency that is owed to them by their customers to another business, a custody provider. In the second example, maybe Acme Clothing Company has made the decision to keep those assets internally to them. So rather than the Bitcoin, after they've gone from the e-commerce platform, rather than Bitcoin going to a custody provider for storage, they go straight to a cryptocurrency wallet or a series of addresses that are owned directly and controlled directly by the Acme Clothing Company. A few more examples. Maybe there's a payment processor in between. The e-commerce platform receives the Bitcoin goes to the payment processor, and then it's the payment processor's job to divide that Bitcoin up in any way that suits Acme Clothing Company the best. So for example, it might convert some of that Bitcoin immediately into fiat, and then the fiat currency would arrive in Acme Clothing Company's bank account, a ledger we should be able to see relatively easily. And maybe a portion of the Bitcoin actually goes to Acme Clothing Company's cryptocurrency wallet that they control, that they own, that should exist on their own IT servers when we come in on day one. Or conversely, the portion of the Bitcoin that goes to Acme actually goes to the custody provider. So there's a letter there to be sent to the Acme Clothing Company's custody provider to understand what records they keep about Acme and what might they be able to share with us. So in terms of our priorities, these are really the three main things that we should be doing on the day. So taking control of the services, so all of the accounts for payment processors, custody providers, the exchanges, all of that should be transferred to the liquidator, and maybe thinking about some additional security measures such as multi-factor authentication. As we know, cryptocurrency is very quick and easy to move if someone has the private keys to be able to make those movements. So very quickly, we want to be able to take the cryptocurrency out of the control of the business and into the control of the insolvency practitioner, so that we can be sure that that value is retained by us rather than by the business without us knowing. There could be maybe some reporting features as part of the payment processor or the custody providers. Maybe people in Acme Clothing Company's finance team received monthly, weekly reports which explained exactly how much Bitcoin has been stored, how much has been sent, how much has been paid off as transaction fees. All of that kind of information we're hoping to get from the services. The wallets is very, very important. This is the idea. If Acme Clothing Company was not using a custody solution to receive the cryptocurrency that was owed to the company, but rather was controlling its own addresses, we want to take control of those addresses as quickly as possible. And as we mentioned here, once again, physically taking control of a device may not be enough. So coming in on day one and someone saying all of the private keys to all of our wallets that received all of our cryptocurrency are held on this USB stick, here it is. We don't know who else might have copies of those private keys. We don't know whether this is the type of address that requires more than one private key to move the funds from. And therefore, very quickly, we want to be able to not just take control of the private keys to be able to access the addresses, but also take control of the underlying Bitcoin by moving the Bitcoin from those addresses to addresses that we, as the insolvency practitioner, control, usually through a custody provider that we've thought of therefore on day zero. What else? These are some of the more conventional things that we might be looking at: forensic images, looking at the company's leadership, staff computers, servers, other services, obviously email, file storage, development infrastructure, production infrastructure, domains, all of that kind of information that we would typically look for anyway. Now, when it comes to email reviews, pretty common as part of an insolvency type situation. We suspect that there are digital assets, but no one has mentioned it. So perhaps we're not looking at the Acme Clothing Company scenario where it's pretty clear that they received cryptocurrency for the sale of their products. Maybe we're looking at another business, but we're hearing a few hints that this business might have invested in cryptocurrency. Maybe some of the directors have used some of the business's funds to put money into cryptocurrency. One of the ways you might be able to do that is by following this link, which was built by one of our colleagues in the US who works in blockchain analytics as well. And this will generate a list of keywords to be run across your e-discovery platforms. It can be as long or as short as you want it to be. The point is, very quickly, when you're running, say, across a relativity instance, very quickly you can run these keywords and see if there are mentions to exchanges, certain payments being made, maybe long sequences of numbers and letters, private keys that we're used to seeing, or addresses that we would be able to follow funds from. That kind of information is very important for us. Now, we've done the first day. We think we've secured everything we need. We're now 100 days in, and as sometimes happens, assets are missing. Now, mistake or malice is really the aim of the game here. Sources of truth, as we mentioned, e-commerce platforms, sales created, invoices, ledgers, payment processors, payment request information, that there is some form of communication that will have happened that talks about these instances, and that's the kind of information we're looking for. Now, what we also have access to is the blockchain, which is all public, and all of the information that we need, all the transactional information that we would want to access, is stored publicly on the blockchain, and we can verify that information ourselves. So rather than in a fiat scenario having to contact the bank and make sure we've got all of the right account statements and all of the transaction details for all the transactions on that account, rather than having to do that, we can just very easily publicly look at the blockchain ourselves to confirm maybe some of the transactions we've seen, and to better understand where the funds may have flowed. Now, this is where block explorers come into play. Block explorers essentially ingest the blockchain and provide a way of being able to trace cryptocurrency transactions. Now, you can do that yourself. There's a lot of very public and useful block explorers. For example, blockchain.info is always a favorite. But you also have a number of blockchain analytics firms who can help as well when things get a little bit more complicated. For example, when funds start being mixed, or there seems to be a deliberate attempt to launder the transactions, this is when you might want to involve a blockchain analytics firms, and there's several out there who might be able to help you as well. Similarly, if you think you found something as a result of looking at a block explorer, so for example, you might have had an address that you knew was controlled maybe from your email review, you knew it was controlled by Acme Clothing Company, you've looked at some of the transactions out and some of them look a little bit unusual, and maybe you can even see that some of those transactions are being pulled further down the line at an exchange here, Coinbase, a very large US exchange. Just contact Coinbase. We've identified assets that we think may have been stolen from us. We're the liquidators. Could you give us any more information, please, about who owns those assets, whether they're still there, whether we might be able to recover them, and then hopefully Coinbase will be able to return those assets to you. And it's usually a lot quicker than having to go through, series of disclosure orders against financial institutions or that kind of communication with financial institutions to get the information you need. If we dig a little bit deeper, there are other sources of truth. There could be other evidence. We've listed a few there. Browser history. Are there any cache versions of BitPay administrative pages? BitPay here in the Acme Clothing Company might be acting as a payment processor for some of the cryptocurrency transactions. Has anyone tried to visit these admin pages and then try to delete their browser history, for example? Can you see any fragments of that? Maybe in terms of wallets, can you find any mentions of those addresses anywhere else online? So perhaps you have tracked some of the cryptocurrency from Acme Clothing Company to another cryptocurrency wallet address. Maybe looking at mentions of that address online might show that it's been connected to other similar events. Maybe it's been connected to a wider theft. Maybe law enforcement is already investigating that wider theft. Maybe other private sector actors are also investigating that theft. Maybe they could be able to share some information with you. And also, obviously, the classic of social media and open source research. While most employees struggle with the loss of their business, is anyone sharing any new lavish trips or toys? So the conventional asset base of the company might be very low, but that could be because the business owners have actually managed to get everything out in cryptocurrency before. And therefore, there's some red flags there for us to dig a little bit deeper. That concludes the very quick and short overview of some of the questions that we would want to ask within an insolvency scenario. And we'll just open up for any questions that anyone might have. I can see a question has come through. Can you change a private key on crypto day one to secure it? The short answer is no. So each cryptocurrency address will have essentially two keys, a public key and a private key. The public key is the address itself that you share with others to receive payments into that address. And the private key is forever assigned to that specific cryptocurrency address. So the only way to make sure that you are the sole owner of a private key, i.e. being the sole owner of an address, is by transferring the funds out of an address into one that you have created yourself, or you absolutely control through your custody provider. We've seen instances of people thinking they had control of those addresses because they had the private keys, but actually those private keys had been shared with a few other people. And when, I don't know, this is usually in a law enforcement context, when news gets out that someone has been arrested as part of a scam, say, and they were the money man, they were someone in charge of the cryptocurrency addresses. As soon as news gets out that they have been arrested, even though everyone thinks they've now got control of the private keys, maybe their co-conspirators also have those private keys, and they'll just move the assets. So you need to absolutely move them back into your control and your control only.
Although that you can be slightly more nuanced in answering that, is if you set up, for example, an Exodus wallet or an Electroneum wallet, you can also create a master private key for multiple wallets using a 12-word secret phrase, which you can define. When this master private key is run through any kind of standardized algorithm, an almost endless amount of private and public keys can be created, and you can keep track of all of them using this master phrase. So that's a kind of alternative route if you prefer, I suppose, letters to numbers and words to numbers.
We were involved in selling various seized crypto via auction. Do you feel this method of sale will increase among insolvency cases? Absolutely. There is there's actually some really good information about how the sale of cryptocurrency via auctions has helped maximize the value of that crypto and therefore maximize the value of the recovery that you will be making. There are a few actors who do that. The US government, usually when they seize cryptocurrency, they make sure it gets sold via auction. You might have heard a couple of weeks ago, they were able to seize nearly $1 billion worth of cryptocurrency from the Silk Road case, which has been ongoing for many, many years. In the UK, for example, I'm aware that the Wilson's auction group usually do cryptocurrency sales as well. We've heard even of people being able to seize cryptocurrency, selling them at auction, and actually getting a price maybe 5 to 10% more than the market value on that day for that Bitcoin, because it's a very quick way of people being able to buy cryptocurrency. So yes, I think we will see auctions being more prevalent. There are some things also to bear in mind with auctions. We need to make sure that whoever is buying those cryptocurrencies, again, are themselves legitimate actors. We don't want the auction to be a way for criminals to get their hands on cryptocurrency as well.
There's also a question on, are you able to search for cryptocurrency ownership amongst directors? Quite simply, best way of doing that is to get hold of the computers from any business and run keyword searching across that for kind of clues, so to speak, that they may hold that currency. If you kind of trigger any of those keywords, you can kind of explore more deeply and actually possibly find copies of private keys in there, or at least know that you have to ask the question and see if you can find paper versions or hard, I suppose, USB wallets which may store those keys.
It's the fundamental difference between I think one of the main, a very important point to bear in mind with cryptocurrency is, if we're talking about Bitcoin, for example, Bitcoin is not anonymous. It is pseudonymous. You will always know at least something about the person that you are transacting with, and that something could be just their address. That's already something which makes it pseudonymous. So finding mentions to try and attribute an address to an individual is quite hard, but using a combination of computer forensics, open source research, maybe even source inquiries with people who might know that individual, you might then be able to do that attribution. And once you've done that attribution, you've got an address with a full record of transaction history on the blockchain that you can easily follow and see what you want to do with.
Hugo, you mentioned on your example emailing Coinbase to ask for any KYC information they would have. What sort of thing would they potentially have on a client?
Yes, it's a good question, and Coinbase is an example of the type of exchange that will have very good information. Typical information you could expect really for someone trying to open a bank account. I mean, it really does depend on what kind of transaction activity is going on that Coinbase account, but you'd expect them to have a name, a passport, maybe even a source of fund statement, source of wealth statement, expected transaction patterns, the kind of information you would typically expect from a bank if you're asking for disclosure about a bank account. Now, I have to stress though that Coinbase is an exchange based in the US that it's in their interest to have a lot of information about customers. There are a lot of cryptocurrency exchanges out there who have far less stringent requirements for onboarding customers. There are a lot of exchanges who might simply require an email address or don't do adequate checks. So we've come across, for example, some exchanges where once we've asked for KYC information, we find that actually it's the information we're provided is the outcome of identity theft. So it's a completely fake identity, a passport that's been stolen, credit card details that have been stolen, and those have been used to purchase cryptocurrency and then receive some of the stolen funds that we ourselves are trying to trace through that exchange. So you know, as a general rule of thumb, if you're dealing with an exchange that is based in a regulated country or a jurisdiction where you would typically expect that kind of information to be forthcoming, then yes, you should be all right. But as soon as you get into, I don't know, an exchange based in, we've had issues, for example, with Indonesian exchanges. So exchanges over there don't really typically have the kind of information that we would require.
The latest updates. By that, I assume you mean the updates which were announced in October. In which case, you know, it's a bit of a controversial subject in the sense that they've made a really odd step. Up until now, it's all seemed to be positive, but the latest announcement I saw anyway was that they were implementing a ban on all crypto derivatives in the UK. Like basically the derivatives such as futures and option trading. However, the ban doesn't prevent holding or buying the actual cryptocurrencies themselves, which are still legal and can't be banned, being completely decentralized and out of government control. So instead, they've been banning these crypto products. To me, it's unclear what effect this will have on the market. Although what is clear is that it seems to show that the FCA doesn't truly understand cryptocurrencies in general, in the sense that they still have some slightly outdated views. Like firstly, their rationale stated that cryptocurrencies have no inherent value. There is a strong argument that, you know, nowadays most people view Bitcoin as having an inherent value. And there are ways of efficiently valuing Bitcoin, basically through its cost of production, the scarcity models, the models based on Bitcoin as a global store of value. There are metrics for valuing Bitcoin, so that's essentially not true. The second rationale was that there's a high prevalence and association with cyber theft. I think it's becoming far more legitimate, and that the legitimate section of the market is growing rapidly. So it seems very, you know, old-fashioned in a sense to kind of view cryptocurrencies as inherently criminal. Thirdly, you know, they point out the volatility. Yes, Bitcoin is volatile in comparison to other assets. However, the volatility within the market has actually consistently declined since its inception. And as it grows, this volatility seems to inversely also decrease. I mean, they give several other kind of rationales, you know, such as a lack of legitimate investment needed for retail consumers to kind of invest in the products. And that seems odd, because it sounds to me like they're saying there's no need to invest in crypto, yet they're kind of banning the options, and it just seems slightly odd. Is that they're saying that there's a need to invest in other assets? It just seems like a very odd rationale.
And I think there's a clarification, a good clarification that's come through, which is the ban of selling crypto derivatives is to retail clients.
Yeah.
Andy, I'm wondering that there's a question here which asks, in the event of an individual business has had their crypto assets stolen or misappropriated, and further to a blockchain investigation, you can determine that they are or were with a well-known crypto company, say Coinbase. How often will they provide their KYC information and return the assets? Thomas, who's asking this, says, in my experience, this is often followed by a pre-action letter and a Noric Pharmacal application. Is your experience any different? I'm wondering if you could just talk us through a little bit that process and our experience of it, Andy.
Sure, thank you, Hugo. And it's a very good question, and it's something that we are dealing with on a number of live cases at the moment. And similarly, our experience is that process as well. In an ideal world, we would hope that the exchange would provide us with the KYC information if we're able to demonstrate credible evidence that there has been some misappropriation and the funds have flowed to that exchange. Typically, when we've encountered exchange, they've been in those jurisdictions where Hugo was describing earlier, which are typically less friendly, for want of a better word, or in more emerging countries. And we have, in the cases that we're working on, needed to go down the more legal route. Whether that would be different if we are encountering exchanges in the US or any more Western jurisdictions, I'm not sure at this moment in time, but certainly the experience we've had is that we also need to put the exchange on demand, send in a pre-notification, and then go down the legal route in the local courts or elsewhere where we can get some sort of jurisdiction in order to get this information.
Great. There's another question I think I can see on the adjudication of claims from creditors, which I imagine relates to claim management systems and being able to attribute certain creditors to a loss. I think this is not our area of expertise here, as we are not ourselves insolvency practitioners, but I do want to stress something that we're dealing with a lot when talking to victims of stolen cryptocurrency, or victims who may have invested in a business that provided, say, a cryptocurrency trading platform, but actually it was just a Ponzi scheme, and it's going through an insolvency process. When talking to those kind of victims, we are finding that we have to stress a lot that their loss so far as we can see, is the value that they invested in the business, not the projected returns. With cryptocurrency, the typical promises that are made to people when they invest in these businesses are great. So we've seen examples of some people saying, buy a Bitcoin on our platform, within 2 months you'll have 100 Bitcoin. And they go off and they buy a Bitcoin, and sure enough, the screen balance on their screen where they log on to the management of the investment account does show 100 Bitcoin at the end of the 2 months, and that convinces them to invest even more. So now they buy another Bitcoin or another 10 Bitcoin, and suddenly they're several £100,000 invested into this business. And as an on-screen balance, it shows that they have several million pounds worth of assets. But the point that we're really having to stress, and I imagine it's very common for everyone on this call, is that the loss here is the several £100,000 that have been invested, not the several million that was promised to them, because those assets never really existed. So when it comes to having to manage those claims, that I think certainly from our perspective is the key message. I can see we are nearing the time. Peter, I'm wondering whether you have any closing remarks or anything from your side.
I firstly thank you to the three of you and more generally to Kroll and Duff and Phelps for sharing this with us. I'm looking forward to the rerun of this so I can go over it again more slowly, because there's a lot to take in there. I think when one is looking at a business, trying to understand where there is the cryptocurrencies, how embedded they are in the trading function of a company is a new world for a lot of us to get used to, and just figuring out where it is. The idea that someone can just stuff a USB in their pocket and walk out of the office with a significant amount of value is clearly a challenge to you as a liquidator. So it's but I guess it's always been the case that employers or unscrupulous owners of companies will find ways to hide their assets from you. You've just got to be a little bit more imaginative and creative in trying to track down some of these assets, especially when they're so nebulous in their existence. But really fascinating, gentlemen. I'm really feel I need to go and educate myself more on this as it grows as a commercial process, in which, yeah, it's not going away. I think it's definitely going to be here for the time to come, as you say, and is growing all the time. So on behalf of TMA, thank you all for your time. Thank you everybody for attending. I hope you found it useful, and have a good rest of the week. Thanks everyone.
Thank you for having us, Peter. Thank you.
Thank you, Peter. Thank you, everybody.